Imagine trying to climb a massive mountain. If you stand at the bottom and look up at the peak, it seems completely impossible to reach. But if you stop staring at the top and just focus on taking one single step forward every single day, you will eventually reach the summit without feeling completely exhausted. That is exactly how building wealth works in the real world. Many people believe they need a massive lump sum of money, like thousands of dollars sitting in their bank account, before they can even think about investing. They think the stock market is only for the rich. But what if I told you that you can build serious long-term wealth by just investing a tiny amount of money consistently, like the price of a cup of coffee every day? This is not a fantasy. It is a highly effective financial strategy called a systematic investment plan, or SIP for short. Today, we are going to break down exactly what an SIP is, how it works in plain English, and why it is one of the most powerful tools for beginners to grow their money. Let us start with the absolute basics. What does the word SIP actually mean? SIP stands for Systematic Investment Plan. Do not let those fancy financial terms scare you. Let us break them down one by one. Systematic simply means doing something regularly, according to a fixed plan or system. Investment means putting your money into something that has the potential to grow over time, like a mutual fund. And plan is just your personal map or strategy. So, when you put it all together, a systematic investment plan is just a way of investing a fixed, predetermined amount of money into a mutual fund at regular, scheduled intervals. This could be every week, every month, or even every 3 months. The most popular choice for most people is once a month, usually right after they receive their monthly paycheck. Instead of trying to save whatever random money is left over at the end of the month, an SIP completely automates your savings. You decide on an amount, say $50 a month, and that money is automatically transferred from your bank account into your chosen investment on a specific date. You do not have to log in, you do not have to make complex decisions, and you do not have to worry about forgetting. It happens completely on autopilot. To understand this even better, let us look at a simple everyday example. Imagine you have a physical ceramic piggy bank sitting on your desk at home. Every single Friday, without fail, you drop a $10 bill into that piggy bank. By the end of the year, which has 52 weeks, you would have saved exactly $520. That is a great savings habit. Now, let us take that exact same habit and turn it into an SIP. Instead of dropping that $10 bill into a physical piggy bank where it just sits there and does absolutely nothing, you set up an automated transfer of $10 every week into a mutual fund. A mutual fund is like a giant bucket of different company shares managed by a professional. When you put your $10 in, you are buying tiny pieces of all those companies. Over time, as those companies grow and make profits, the value of your tiny pieces increases. So, instead of having exactly $520 at the end of the year, your money has been working for you. Because the stock market historically goes up over the long term, your $520 could grow into $550 or even more. You are doing the exact same physical action of putting $10 away, but the outcome is completely different because your money is actually growing. One of the biggest fears people have about investing is timing the market. They worry that they will invest all their money today and the market will crash tomorrow. This is where the superpower of an SIP comes in. It is called dollar cost averaging or rupee cost averaging. Let us explain this with a simple grocery store example. Imagine you love apples, and you decide to spend exactly $10 on apples every single week. Some weeks, there is a bumper crop, and apples are very cheap, costing only $1 each. On those weeks, your $10 buys you 10 whole apples. Other weeks, there is a shortage, and apples are expensive, costing $2 each. On those weeks, your $10 only buys you 5 apples. Over time, you did not have to stress about when to buy apples. You just spent $10 every week. When prices were low, you automatically bought more. When prices were high, you automatically bought less. The average cost you paid per apple ends up being much lower than if you tried to guess the perfect day to buy them. This is exactly how an SIP works with the stock market. When the market is down, your fixed monthly investment buys more units of the mutual fund. When the market is up, your investment buys fewer units. Over the long run, this smooths out the ups and downs of the stock market, protecting you from making bad emotional decisions. The final reason why SIPs are so incredibly powerful is the concept of compounding. Compounding is when the money you earn on your investment starts earning money of its own. It is like a snowball rolling down a hill, gathering more snow and getting bigger and faster as it goes. Let us use some simple numbers. Suppose you start an SIP of $100 every month. Let us say you do this for 10 years. In total, you would have invested $12,000 of your own money. If your investment grew at an average rate of 10% per year, you would not just have $12,000. Because of compound interest, your total balance would actually be around $20,000. That is an extra $8,000 that you did not have to work for. Your money did all the hard work for you. And if you kept that same SIP going for 20 years instead of 10, your total investment would be $24,000, but your final balance could grow to over $75,000. The longer you let your SIP run, the more dramatic the compounding effect becomes. This is why starting early, even with a very small amount, is much better than waiting until you have a large amount of money. To sum it all up, a systematic investment plan is not a mysterious or complex financial product. It is simply a smart, automated habit. It takes the stress out of investing by allowing you to invest small amounts regularly. It protects you from market ups and downs through dollar cost averaging, and it uses the incredible power of compounding to build your wealth over time. You do not need to be a financial expert or a millionaire to start. All you need is consistency and patience. Thank you for watching today. Follow Beeps Finance for more simple money